All right. Hello, everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. We have seen another pretty big rally in the overall market over the past couple of weeks. It has been a direct result of the headlines that we've seen released. We've had news out of the trade war with China. We've had the Fed announcing more stimulus to this economy, trying to prop market up. We have now seen news out of Brexit. We've seen good earnings releases so far on the companies that have released their quarterly earnings. And as a result, this market has been on another quest towards the all-time highs. We are now seeing a lot of overbought markets in the near term. The reason I point this out, if you have an opinion on overall market direction, it really benefits you. It really can help identify good opportunities. And it doesn't mean strictly looking to buy calls and puts. It's where so many people go when trading options. I'm not opposed to buying calls and puts, but that's not the only strategy that's part of my toolbox. I am very selective when I buy calls and puts because that's the most aggressive strategy you can use. If I buy a call option, the only way I make money is if that stock moves higher, and it does so quickly. If it takes too long, if the move's not big enough, I'm not going to make any money. In fact, I'm probably going to lose money. That's why in periods of more uncertain price action, if you hit an extreme like we're seeing now where we've got a lot of overbought markets, I'm expecting this market to start slowing down. I'm expecting a potential pullback here in the next few weeks, but I don't want to just come in and buy a long put. Buying a put option only allows me to make money if that stock moves lower immediately, and it does so in a pretty big way. I'm not convinced that this market is going to fall out of bed here anytime soon. If I'm expecting more muted price action, if I'm expecting slower, choppier conditions, there's better strategies for me to use. And what I want to do is show you an example of this using Nike, symbol NKE. We're going to take a look at selling a call spread. Looking at this chart of Nike, you can see the last number of weeks, it's been an impressive move to the upside. If I back out and show you the full year, Nike has been one of the stronger names on the board. It just continues to move higher every week. As a result, we are at an overbought condition. And the way I measure that, you can see my red and yellow histogram down at the bottom. That's what we call our pulse indicator. And just over the past 4 or 5 days, we have started to see a whole series of yellow bars plot. Those yellow bars represent between a 1 and a 2 standard deviation channel move on the upside. In other words, we're overbought. It doesn't mean Nike can't move higher. It just means going forward, it's going to become statistically more difficult. Odds favor a period of consolidation or even a reversal to the downside. It does not mean Nike's going to crash, but it does mean we're getting a little long-winded here on the upside. All I need on my pulse indicator is 3 out of the past 5 bars plotting as yellow. We certainly have that here on the right edge of my chart. So what I want to do to take advantage of this condition, I'm going to go over to the trade page, and we're going to take a look at selling an out-of-the-money call spread. What do we know about out-of-the-money options? They have a very low probability of success. The chances of an out-of-the-money call option going in the money, they're slim, depending on how far out of the money you go. Well, instead of buying the out-of-the-money options, what if we go in and we sell the out-of-the-money options? Now we're putting the odds in our favor because we know chances are those options are going to expire worthless, and I can profit from that by selling a call spread. You don't have to be intimidated by this type of strategy. I know a lot of people tend to shy away from a credit spread because they think it's so risky. It's not. It's actually much safer than just buying an outright call or a put. We know what our max loss is right up front. It is a defined risk position. Well, what I did is I went out to the November 15 monthly options. Those are the options that have 29 days left to expiration. I love the weekly options. I know a lot of you love them as well. I'm not opposed to trading the weeklies, but I'm selective when I use those. I tend to use the weeklies when the market is more active, when we're in a higher volatility environment. The volatility the last few weeks has gotten crushed. The volatility has been sucked out of this market here the last couple of weeks. And as a result, I'm going farther out in time. I'm going out to the monthlies because there's more juice in the options. There's more premium for me to collect. And there are more liquid options as well. There's more volume and open interest in the monthly options. That's to my advantage because that's going to make it easier for me to get in and out of trades quickly and at good prices. Well, I went out to the 97.5 call. Why did I go to that call? It does get me out of the money by a few dollars. It's $2 out of the money. But more important, it has a 66% chance of closing out of the money. I like to look to sell options that have around a 65% chance of closing out of the money. That's the ideal scenario for me. So I right-clicked on the 97.5 call. I went to sell, and I selected vertical. And it opened up an order down at the bottom where I'm selling the 97.5 call, and I'm buying the 100 call at the same time. As of this video, it was trading for 70 cents mid-price. Okay, I would be okay taking this trade. If I can get filled 60 cents or higher would be acceptable. In this case, we can collect 70 cents, which is even better. What I'm doing here is I'm collecting $70 up front, $70 per spread. That's the most I can make on the position. If I am perfectly right on this trade and Nike starts to move sideways, it starts to move lower, the most I can make is $70 per spread, which it doesn't seem all that impressive, right? Look what the maximum loss is. Look at the amount of capital required to put this trade on. It's only $180 per spread. Where is that number coming from? It's the difference between my two strikes down here, the $2.50 difference between those two strike prices. And then we subtract the 70 cents that I am collecting to put the trade on. That leaves me with $180 maximum loss. I'm tying up less than $200 of capital. And best part about this, I give myself 5 ways of making money on the trade. How does that work? My break-even point is at 98.20. You can see it here in my order confirmation box. That break-even point is calculated by taking the 97.5 call that I am selling, and I'm going to add on the 70 cent credit that I'm collecting to put the trade on. I don't care if Nike moves up, down, or sideways. As long as it stays below 98.20, I get to make money. I can be dead wrong by $2.60 and I can still make money. Ideally, I want this stock to move sideways or lower. But if it continues to drift higher, I can be dead wrong by $2.60 and I'm still okay. How does that work? Because anytime that you're selling an option, or in this case, I'm selling a spread, the time decay is helping us. Every day that we hold this position, the time decay is adding up in our favor. I also make money if volatility decreases. So it gives me 5 ways of making money on the position. If the stock moves up, down, or sideways, I make money as long as Nike stays below 98.20. I also make money if time decay adds up, and I make money if volatility decreases. So now there's 5 different routes that I can go to make money. If I just buy a put option here to be bearish, I can make money, but the stock has to move lower and it has to do so immediately. Now I'm taking the pressure off the timing of the trade. If I'm not perfectly right on the timing of the trade, I can still make money. So what's the trade-off here? Why wouldn't I use a credit spread every time? The benefits, as we just talked about, I've got 5 ways of making money on the trade. It ties up less capital. On the downside, I greatly reduce my profit potential. If I were to buy a long put and the stock moves lower, I've got unlimited profit potential. It's going to be big. I'm giving up that home run profit potential in exchange for a higher winning percentage, in exchange for having more ways of making money on the position. It still gives me a nice profit potential. Okay, so I don't want you to think that these are dull, boring trades that aren't going to do much for you. They're great trades. They're great trades to mix in when you don't have as strong of a directional opinion. When you're a little less certain of market direction, this is a trade that you can put on, take some of the stress out of your trading. It limits your risk, and it's going to give you a higher winning percentage over time. That's why I love these trades. Now, a lot of times people make mistakes with credit spreads because they end up structuring them incorrectly. Notice here that I am risking $180 to make 70. I'm risking between 2 and 3 to make 1. I'm okay with that. I can make that work long term because I've got 5 ways of making money on the trade, because I'm going to have a higher winning percentage. The numbers work out in my favor over time as you continue to take trade after trade. If I start to risk 5 or 6 to make 1, the numbers don't work out. It's harder to get those numbers in your favor over time. Now you need an extremely high winning percentage to make money because one losing trade is going to wipe out a whole string of winners. If you can stay in that risk 2 or 3 to make 1 range, you can make the numbers work long term. So that's why we're structuring the trade the way that we have here. How do we manage it? What's my target zone? If I collect 70 cents up front, that $70 profit potential is only reached if I hold that trade all the way up to expiration. The problem with that is as you start to get closer to expiration, the options become more sensitive to changes in stock price. It's what's known as the gamma risk. I want to try to avoid that increased gamma risk as we get right up close to expiration. I like to close these trades out ideally the week before they expire. In my target zone, if I can close this thing out and keep between 50 and 75% of my max profit, that's ideal. So 70 cents being my max profit. If I can buy this thing back for between 17 and 35 cents, somewhere inside of that range, that would give me 50 to 75% of my max profit. So I'm going to set my closing order initially at 17 cents. That's where I'm going to look to close out of the position, take the partial profit, free up the capital, and move on to the next trade. So that's my goal. That's what I'm looking for. If you have any questions on this one over the next few weeks, if you decide to put the trade on, which I encourage you to do, even if it's in a demo account, put it on, track it, see how it works here over the next couple of weeks. And if you have any questions on it, feel free to post a comment on our blog. You can post a comment on the YouTube video, or feel free to email me directly. Mike@netpicks.com is the email address. All right, so hopefully you found this video beneficial. I'll be back with you guys here next week. We'll take a look at our open positions, and then we'll also take a look at a brand new options trade of the week at that point. So enjoy the rest of your week, everybody, and I'll talk to you again next week.